Larry Shover, Chief Investment Officer at SFG Alternatives, joins us live from Chicago. Larry, some mixed moves that we're watching today underway for NYMEX crude and Brent. Perhaps those comments around US crude and the additional supply that's coming into the market, putting that downward pressure there. What do you make of that? And perhaps that rebalance, those comments around the rebalance, coming back into play for the oil market.
Yeah, a lot of moving pieces, certainly. And as you know, this whole thing about U.S. production amping up its growth is not a new story, but it's a story that the market's starting to pay attention to now. Before, it just didn't really matter. And also, like the inventory reports, whether they were bullish or bearish, oil continued to rally. That's not happening anymore. And I think the market's just coming to terms with the fact is like, will demand be 1.8 million barrels a day like it was in the second half of 2017 to support the price that we've just seen? That's a lot to ask. We have to remember that emerging market gasoline prices are back to 2013 levels. Another mark on demand. And when it comes to supply, I'm still worried about compliance and the compliance rate no matter what the headlines say. So I do think there's a bearish tilt to the crude price. It's never easy, but I do believe it will continue to drift lower, at least as we go out to the next couple months.
Will that be a continuing, ongoing theme this year, do you think, with the supply obviously whittling away from those OPEC producers kind of pulling out of the market, but on the flip side, the additional supply coming in from the US shale side of things? Do you think that's going to be an ongoing theme that the oil market will have to grapple with throughout 2018?
Yeah, great point. And I think it will be. And that's why predicting the oil market on the short term is so hard to do. Medium to long term, somehow it's a little bit easier. But yeah, I think the production growth will continue to ramp up. I know that OPEC wants prices around $70 a barrel. It makes sense to them, but doesn't make sense to the market. So I think that, combined with the fact we have to keep in mind that, the last half of 2017, the demand was 1.8 million barrels a day. It's a lot. And so it's going to have to sustain that, which is very, very hard to do in order to sustain any kind of sustained bullish momentum in crude price.
All right. Look, we're watching obviously moves in those commodities. What is your view on investing in some of those mining and energy companies? I know previously we've spoken to yourself, Larry, and other of our analysts that say, look, it is a good play on the global growth story, the synchronized global growth, which is expected to continue. Would you agree with that? And do you think that the mining and energy companies and the commodity sector is a good play on that theme throughout this year?
Yeah, I think by and large the answer is yes, it is, and maybe not so much on the global growth scene, although that's part of it. I think it's more about inflation, and if we start to see inflation like they're predicting that we will see, you've noticed that commodities / cyclical stocks are really a good inflation hedge. They tend to do very well during I'm talking about 1 to 3% inflation, not extreme scenarios. So. Beyond that, when it comes to energy stocks, I still maintain that when you look at valuations compared to the rest of the market, they're very, very attractive indeed, even if oil prices come off $5 to $10 a barrel.
Larry, let's talk a bit more about the market today. A bit of an unwind for the S&P and the Dow Jones. A different story, I suppose, for those tech stocks. Walmart shares seem to be adding that pressure. What else is contributing to perhaps the decline today? Certainly coming off the back of a very, very good week last week. The S&P, I think its best week in about 5 years or so. Yeah. So obviously unwinding from that. What else is contributing to those negative moves, though, today?
Yeah, I think really it's sentiment. I mean, we did rally. I think the S&P was like 5% last week, and I believe their sentiment just maintained that we're going to have a V-shaped recovery. It's going to go back to the highs, and that's not coming true. Right now, the market's coping with higher yields and the inflation adjustment debate, and so how that's all going to pan out. So I think it's going to be some tough sledding, and also. The dollar dropped like 1.5% last week. It's up today again. That definitely is proving to be a cap on the market right now. People scratching their head, not understanding why. So I think that's really what is going on today.
Now we're watching a rise for those bond yields as well, of course, ahead of those FOMC meeting minutes. And I suppose hoping to see some further clues on the path of interest rates this year from the Federal Reserve, but in particular respect to the rising yields there. In addition to that, we have a big amount of supply that's about to come in from the government debt side of things, I think about $2.5 billion this week. What are the potential implications of that?
I think the implications are actually lack of liquidity, and I would say 10-year yield is starting to press towards 3%. I think that'd be a good place to buy in the short term. I do think yields are going to reverse. I don't think they're going to be going back to the lows of the past 12 months, but I do believe there's this positive long length, as it were, in Treasuries. So I think people expect them to go up to 3.25, 3.5. I don't see that happening. So 3% is a big resistance area, good place to get long the 10-year yield.
Okay, fantastic. Look, Larry Shover, we'll leave it there. Appreciate you joining us as always, though. Thank you so much for your time today.
Thank you.